and processes. So for impact, it uses ESG as the foundation, but then it's a level of rigor above that. And outside of the impact space, those that are truly dedicated impact investors, there's confusion about, well, what's sustainable, what's ESG aligned, and what is impact. And this has improved over the years, but it's really up to the market to clarify for investors so that they can actually move their capital to where they want the capital to go. If they are trying to have a positive impact, they're probably wanting to move their capital towards impact investments. So the EU regulations have actually been a little bit helpful between Article 6, Article 8, and Article 9. So if you really have sustainability as an objective, you are generally going to be an impact fund. Not 100%, but most funds that are reporting under Article 9 do have impact as one of their goals. So the regulations can actually help better define for the market and drive the investment capital to where it actually wants to go. So that's one piece, but really it's all of us on the panel and in this market to really help continue to educate investors about the different ways of investing for good. And that plays into, right now, it is tough to raise capital. It's, we've had COVID, we've had the Ukraine war, or we still have the Ukraine war, but it's just one of those challenging periods of time. And markets do have, they have great periods and they have difficult periods. This is one of those difficult periods, but impact capital is patient capital. It's patient. It usually invests over the long term because it wants to achieve a specific outcome, but it also wants to promote systemic change where possible. So it's also patiently waiting for that capital to move in that direction. So continuing to educate the market and continuing to show these different types of offerings will attract more capital over time. We just have to be a little patient ourselves about getting through this time. When you mentioned, though, that a lot of the poorer countries and frontier markets are not getting the access to capital that they should, there is a risk factor that is involved. Not everyone is comfortable going into developing markets versus developed markets, and there's still a lot of impact capital going to developed markets. So there are different ways to reduce that risk to then, catalyze private capital for these markets. Some of it, one way is blended financing, and this is something that's been done for years by multilateral development banks and development finance institutions. So they provide some risk mitigation. It could be on the foreign exchange side, it could be on the sovereign risk side, it could be on the performance risk side. But if they can take a first loss, meaning if there's any capital loss, they take that first loss. So they can reduce the risk, and that would encourage private capital to join them in investing in these companies. So that's one way. Also, what I mentioned, foreign exchange risk mitigation. There are many firms out there that are now providing foreign exchange risk. So they can reduce that foreign exchange risk so that you want to get the return in your home currency, be it US dollar, British pound. So there's other ways of reducing the risk. So there are also organizations that just offer guarantees. So adding that guarantee to the structure reduces the overall risk. So there are ways by bringing in both public and private sector capital that you can reduce the risk and mobilize more capital for these developing countries. One issue that comes up a lot, and I'm sure Natalie will get into this more, is what is required for impact in some of these difficult markets is you have to obtain data from your investees so that you can actually report, you can monitor the impact, you can target the impact, monitor it, and then measure it at the end. This is a burden on the investees, and some of the investees they could be in the venture capital space where they're very early stage companies, and that data is hard to come by. You could be in developing markets where the data is also hard to come by. So data is an issue in impact investing, and it has been heightened because of some of the regulations. In SFDR, there is a requirement for certain data. In the EU taxonomy, there's even more so. So some organizations are opting out of reporting under the EU taxonomy because they say, we just don't have the data. So data is something that has been a recurring issue in impact. I am heartened by the fact I see third-party providers working with asset managers to kind of aggregate the data and provide some kind of data sourcing that was not there before. It's early stages, but it's something that is an ongoing effort on the part of impact investors. So I think, making sure, in summary, making sure that we all understand what impact is and continue to have those conversations, reducing the risk where we can to really mobilize capital in some of the more difficult markets, and focusing on how do we then get the data that investors need to better evaluate what investments they want to make. Those three things could really help mobilize more capital and help us get nearer to the SDG targets.
Yeah. So thanks very much. I think these three areas are something that we also see as being quite essential. I mean, and that we see it apart working Gold Standard and Pegasus Capital Advisors. So Natalie, to you, adding on to that, based on your experience as a practitioner of someone trying to drive sustainable development through financial vehicles, how do you see that? Is there anything you'd like to add to what Diane said in terms of, the importance of clarity on ESG and impact? What is impact? The importance of how to address risk of frontier countries or low-income countries, how to get money to go where money has not gone before, sort of thing, and how to get this data, how to get the data right. How are you doing it, actually?
Yeah, I think I want to touch upon a little bit on the notion of impact investing and what Diane has mentioned. I mean, there is a need for greater consistency. What is impact? Transparency, so the measurements, the KPIs, the impact that we report on, and just the general understanding from the measurement perspective, but then also from a commercial perspective. I think, as Diane mentioned, I think we still need to differentiate between ESG strategies, which are traditionally more focused on risk mitigation when it comes to environmental, social governance issues, such as pollution management, health and safety issues, human rights, labor conditions, and then the impact strategies, which focus on the one hand on intentional, measurable, sustainable development outcomes, and on the other hand focus on additionality. So the question around how additional is my investment, so what would have happened anyways, where would the capital go anyways, compared to various capital scores, which areas are underfunded to have this deep impact. And I think especially when it comes to emerging markets and developing countries, these are the markets which are underfunded because it's more difficult to access capital. And also just in terms of the measurement, I think it's also important to differentiate between measuring ESG data. So that's, for instance, we report on Scope 1 and Scope 2 emissions, the number of waste, the number of health safety incidents, and so on. But then compare that to actually measurements and KPIs and methodologies that focus on sustainable development outcomes and the impact. It's different. And I think there's still a lot we need to do to better understand how to measure this, which methodologies to use to be transparent, to be consistent, to make those impact claims. So I think we do see a lot of more data and disclosure requirements, the European regulation, for instance. But I also think that Gold Standard is doing quite a pioneering role with the recently launched impact fund requirements. So we at Pegasus, with one of our funds, the Subnational Climate Fund, which is focusing on infrastructure and agriculture in the global south, we are actually piloting the Gold Standards Impact Fund requirements, which means that for each of our investment, we need to have targets in place, we have to have the KPIs in place and methodologies, not only on the outputs, but also on the outcomes to be able then to measure the impact, besides having the impact strategy, besides having environmental and social safeguards and stakeholder inclusivity requirements. So and then we also need to have the measurement reporting system in place, which goes through third-party audits. So I think assurance third-party audits, it's also quite new to the market, but I think it's important to ensure the transparency and also to assure investors and stakeholders that those claims that we make are actually real and that impact is happening on the ground in the real economy. So I think the standards, regulations, they're evolving, frameworks are evolving as well, but I still see those mostly focused on ESG performance. And also they often have the lens of developed markets, which goes back to the kind of data collection problem that Diane was mentioning. So for us, we really need to engage and work with the investees to actually collect the data, measure the data, which also means providing a lot of guidance, a lot of support and resources in order to do so. And just briefly, I also want to touch upon kind of the commercial side and the risk side. So I think we also have to be clear that impact investing has to be for-profit impact investing. And I say that so specifically because in the market, I think there is still a perception that impact investing is not making any returns, which is untrue. And I think we just have to be realistic if we want to unlock the trillions. It means that we have to have the triple bottom line impacts, which are environmental, social, but also the financial returns, in order for commercial investors to come in so they can achieve market returns and their risk adjusted returns. And I think here, as Diane mentioned, in order to address the barriers for new investors to come in, there are several instruments, blended finance. Also, the Subnational Climate Fund is a blended finance vehicle benefiting from a junior tranche. So from the Green Climate Fund, for those who are not familiar with blended finance, it's basically pulling together different type of capital sources, such as public capital, such as private capital. For us, the public capital comes from the Green Climate Fund, which is willing to absorb higher risk. So that basically means that all the investors, the senior investors that come in at the later stage, they get their money back first and their return before the Green Climate Fund sees any money. And this serves kind of as a protection, which should really make it attractive for investors that are new to emerging markets, that are new to climate finance, to come in with a lower risk.
Thanks very much, Natalie.
Yeah.
I think that's added quite a lot of nuance, from the practitioner's side. It also sounds quite overwhelming, that there's a lot of ambiguity, how to do impact, how to measure it. It's still quite a new thing for many people. And, is there a risk, Marco, I'm turning to you as another practitioner looking and advising with funds and blended finance, is there a risk that impacted investors might get distracted or overwhelmed by all these standards, regulations, risk requirements, and frameworks, so that they just feel like, unless it's a checkbox, I won't do it. I can't do anything unless it's super, super simple. And we know that impact can be simple, but we're not there yet. So how do we deal with this dilemma of people sometimes just feeling overwhelmed, right? So how do you see that?
Well, thank you, Felicity, for being part here. And as you said, I'm much more of a development practitioner, and therefore I think these kind of conversations are so important to talk about how impact investment in the financial sector and actually the people and organizations on the ground doing this stuff can actually learn from each other and actually increase impact, because that as a practitioner, you want to achieve the maximum impact of the work you are doing on the ground. And we've seen that with the philanthropic capital, that's not enough. So we really try to use, I think how Natalie explained, use that kind of patient capital or philanthropic capital as a buffer or first loss for attracting much larger amounts of capital. But I would say I'm more overwhelmed with the risk of not achieving the SDGs. And I think the conversation therefore sometimes goes off in the wrong direction. As you explained in the beginning, when we see the data, we're not achieving the SDGs by 2030. These were promises on top of the MDGs that we should have already achieved by 2015, which we didn't. And we're not seem to be getting the climate goals either. So in my view, any investment should become impact investment. And it's not just the niche market that we are talking about, it's any investment. And therefore, how can you steer the much bigger markets, the entire financial market? And how can you take that responsibility from corporates and investors and bankers into that direction? So one of course is by showing the way with impact investing that we are doing the right thing and how you can do it and how can you measure and how can you show it works. Another one I think it's very important what's happening, and you were talking about regulations in the EU, so both of you, and I think that for me the ESRS, the European Sustainability Reporting Standards under the Corporate Sustainability Reporting Directive is a big step forward, but we're going to make mandatory reporting for up to about 50,000 companies in Europe with mandatory auditing as well of those reports. So there's no more blah, blah, blah really possible in those reports, to quote Greta, because it has to be audited. So from moving this to a practical perspective of what we've been doing in Brazil is that, and I'm very pleased to collaborate with the Gold Standard Foundation on that, is that the Global Forest Bond in Brazil is a small startup that developed a technology, interestingly enough, used by KPMG to measure GMO soy production. We transformed that into a tool that can actually monitor forests. So we used the tool that was from an agribusiness into a forest production tool, and that tool is the one that provides the background data for the funds that we are developing. So the idea is then, and linking it to the European policy, for example, on deforestation-free soy, how can you help agricultural producers in Brazil that by law mandatory also have, depending on the area where they are, 20 to 80% of their land in a nature reserve? How can you actually start to give value to that forest land, which is outside the economic system? So the fund that we are developing, and it's going to be together with Gold Standard in the certification process and the whole fund requirements, is looking at to bring in capital for the agricultural producers to do their normal production, but with a signed contract that the forest that they have will remain in place, and that will be monitored by the tools that we have. And the advantage at the end of the year, when we have to repay their loan on the basis of their production, if they indeed protected their forest, they will get a rebate on the loan. So that in that way, with the impact investor can be sure that this is deforestation-free soy or corn or other agricultural produce, and the farmer who actually gets an incentive for good behavior on maintaining the forest. And we should know that 2/3 of Brazilian land is actually still native vegetation, and about I think 40% of that is in the hands of private farms. So this is a huge incentive that will stop deforestation, has a huge impact, and will have positive impact locally on the ground as well. So
great, thanks, Marco. I'm sorry, I'm going to interrupt you here because I do want to hear from Justin. And we will come round because we're going to open up for some more questions, I'm sure. But Justin, sorry your camera's not working, which is annoying for you and for us and for everybody on the call. But to you on this point, I think Marco was saying it's really important that it's not a niche market. But of course, we also heard at the beginning that in order to move money where it's not going, there's additional risks involved. So how do we manage that? You know, how do we support greater risk taking? What needs to be done from your perspective?
Yeah, thanks, Felicity. And I think, yeah, it probably does come back to some of the points that were raised by Diane and Natalie around risk sharing and blended finance structures as being ways to crowd in atypical capital into deals where the risk return profiles of deals are changed by having various elements that mitigate the risk. But I think it's beyond that, because I think it's also not just making deals more attractive by de-risking them, but also trying to target capital that by its very nature may have greater risk tolerance. And I think that really is starting to try and engage at a much greater scale with private capital, with foundations, whether they be private foundations or corporate foundations, private wealth in terms of trusts, family offices, where there is significant aspiration amongst the principals to invest for impact. And there is a willingness and desire to be tolerant in terms of return expectations. So, it could be capital protection is their priority rather than market rate returns. or they may be willing to use purely philanthropic capital as catalytic to unlock, to be that sort of first loss, or to be the guarantee. So I think it's not just about the structuring, but it's also about trying to identify who the actors are that are naturally inclined to have their capital work harder, to be impact first, and to be catalytic in unlocking mainstream capital coming into the market. So I think that's my sense. Maybe just reacting on some of the other points about data. I think I fully agree that the challenge, one of the fundamental challenges is providing sufficient evidence that impact has occurred in investments, and where funds are investing into emerging markets, whether they're investing into early stage companies, that is really challenging. I think one of the solutions to that is around having much more robust ingoing methodologies to select investees, so having robust impact assessment criteria for screening and due diligencing. And I think by having that in place, you de-risk the process, because through a robust process, you ultimately are selecting aligned companies, and then you reduce the burden on those earlier stage companies. And I think it also addresses, from our perspective, sometimes the sense that there's it's a bit patronizing to expect early stage companies to report all of this impact data when there should be greater trust in the process. And we've been engaging with one fund recently where they've actually implemented a moratorium on impact reporting for the first 3 years of an investment, because they said it's a distraction on the underlying portfolio company, it's burdensome, and ultimately they need time and runway to get up to speed before they can report genuine impact data. And that relationship's based on trust, and I really like that idea. And then I think finally on impact data, I'd agree with Diane and Natalie. The world is moving rapidly from a kind of show me world to a tell me world, and it's more and more impact funds, in order to prove their impact, they need to go beyond the quantitative output level of data. It's not sufficient to prove impact, and they need to get into outcome focused qualitative data that can prove change over time, that can determine a change in people's lives, whether that's positive or not. And that, in my mind, in our work with fund managers, is a frontier area of impact measurement, is how do you generate granular, disaggregated, beneficiary level data that actually allows a fund manager to prove very, very substantial linkages between the investment and change on the ground.
Thanks, Justin. I agree with all you said, and I think we're looking at a paradox. So this is what I want to put up to all of you, and I don't mind who goes first. But on the one hand, we say people need to do more. They need to look at data. They need to measure more things differently. They need to unpack additionality, and they need to go where they've never gone before and where there's a higher risk. At the same time, we say it mustn't be a niche market. It mustn't be, it has to be everybody. But how do we make that happen? Why is that not happening? Clearly, that's not happening. So I would argue that today what we're seeing is a kind of niche market, which is for some people. But how do we get that for more than just those niche? What barriers do we have to focus on to sort of unpack that? And can you give us some more insights maybe into how it is at the fund level, fund managers, like, Natalie and Mark, you're seeing what it's like to drive it, and Diane with your signatories, what's the appetite to scale what we are learning to get more, to stop it being a niche? What can regulators do? Who wants to go? Diane, you're looking.
If I might, I'd like to be a little bit more positive. I mean, when we launched the impact principles in 2019, we started with 58 institutions. We now have 177 from 39 countries. We've seen the impact assets under management grow over that period by almost 200 billion. And now the signatories represent half of the estimated impact market. So there has been a growth. I've seen the growth in impact assets as signatories provide their annual disclosure statement. So I'm actually heartened that there is interest out there. We are in a little bit of a post-COVID and still ongoing Ukrainian war bubble. That's a unique period in time, and the markets have been very challenged. But I'm actually very positive on the market continuing to grow. If I just might refer to what Justin mentioned about robust impact assessment frameworks. I mean, that was really one of the reasons that we built out the impact principles. They basically provide the framework for what is required to ensure you're investing for impact throughout the life of an investment. And one of them is the impact assessment framework. And you have to have an ESG framework. You must also disclose how does your capital contribute to the impact achieved. So the impact principles have really helped build discipline and robustness in the market, as well as transparency, because all signatories have to provide their disclosure statement on an annual basis, and Pegasus Capital is one of our signatories. So Natalie is very well aware of this. It really does help the market move forward. It's still a young market, so I think some of these roadblocks we're experiencing now, we're talking about it already. It's not that we're ignoring it. So I think that there's a lot of people in there trying to move the market forward in the right way. So I'm actually an optimist that we'll get there. And we have to be a little bit patient, but you've got to push like you are, Felicity, because we have to keep pushing to get to where we want to go. But I think that, and distinguishing between venture capital versus, low income markets, a lot of our signatories are investing in low income markets, and we have some signatories from these low income markets. They're just not necessarily as well known. Them being signatories may help them mobilize more capital for their funds. So I'm optimistic that as we get to know who the players are, and as this becomes more global, it's not just the US and Europe. There's a lot of organizations from South America, from Asia, from Africa that are engaged. So I think it's just continuing to have these kinds of webinars, these sessions where we get to know. And Marco, what you talked about, it's fascinating. I don't think this is known by the global community, but these kinds of opportunities are out there, and we just have to really make sure that we're all aware of it. So I'll be the optimist in the crew.
No, I'm a hearty optimist. I just always I'm called Felicity, not Patience, so I want more. Marco, I also saw Justin had actually put his hand up, and we can't see him, but he put his hand up in the chat. So Justin, if you want to speak now, and then I'd hand to Marco.
Sure. No, I think I just echo Diane's point that I think, despite, the current context, I think the overall direction of travel is set and clear. And I think that journey, the train's left the station, and I think there are a number of key drivers that are motivating the fund managers that we work closely with around integrating leading practices around impact throughout their entire fund life cycles. And I think that's investors and greater expectation from their LPs to do more and to be the best they can be and to continuously improve. I think clearly there is a peer pressure element here. What are my competitors doing? Am I signing up to the same standards and frameworks as them? What was their annual report last year? How are they disclosing data? I think so. There's a positive peer engagement process, and then I think also the regulators clearly are part of that process as well. So I think just wanted to echo that we see a confluence of 3 or 4 key drivers that are motivating fund managers to do more, and we're heartened by a number of our recent engagements have been with what I would call sort of blue-blooded private equity or private debt funds that have never done impact in the past, and we're working with them to basically retroactively look through their portfolios to understand where the potential impact in their portfolio is without that intentionality having ever been there, and using that as a management support tool to then define how they could be more impactful through dedicated new fund vehicles. So if you're looking at mainstream actors who are now turning to impact, that's again a real sign that the market's moving.
Marcus?
Yeah, thank you. Well, Diane, I'm actually a pessimist. At least I wake up a pessimist every day, and I try very hard to get rid of that during the day. So I have a more positive outlook, work very hard on impact as much as we can. So in that respect, I think what we're doing with the Global Forest Bond is really trying to change the needle of moving forests that did not have a value into having a value within the agricultural value chain, and therefore actually hoping to stop deforestation and having agricultural companies in Brazil focus on reforestation rather than on continued deforestation. And also with another organization, Connexus, where I'm in the board and an interim CEO at the moment, We also developed a fund, and we can see a blended fund where we used philanthropic capital as the basis, and we were able to bring in a private bank to fund smallholders in the Amazon forest that collect forest products and support their cooperatives. So it was very interesting that with this blended mechanism, we were able actually to bring in hard capital for market rates to support those kind of people in those kind of circumstances. And I see a very strong increase of both on the philanthropic side to support more these kind of mechanisms, which is great, so that we can actually unlock more of those trillions, and also an increased interest of the impact funds, but also of normal investors. So that's a very positive sign. I do still though feel that we have to be careful that we don't sort of maybe kill ourselves by numbers in the impact sphere, because then it would be great in 10 years we have all the numbers, but we haven't achieved enough. Well, how come we focus so hard on ourselves, and why isn't that the negative impact investors, let's call them like that, which is the big chunk of the capital, which has negative climate impact, which has negative biodiversity impact, which has negative social impact? How come we are not also focusing stronger on them to show that they are actually having that negative impact and trying to transform? And that's why I go back to the European Sustainability Reporting Standard. That's going to have to focus on companies to show their impact, because it has a double materiality included in their standards. So it will make our work as impact investment easier if we can also work on the other side, that the negative impact should be measured probably even more in detail than we measure our positive impact.
Thanks, Marcus. Natalie, did you want to add?
Yeah, I just wanted to add on the last point. I think standards regulation can help address this, but then I also think we should be realistic about if we really want to have the negative impact investors, let's say, move to the positive impact, we also need to meet their expectations and needs. And specifically thinking about what they're looking in terms of risk-adjusted returns. I mean, what Justin mentioned, and I think that's really a positive development. We do see more foundations and family offices and so on coming into the impact investing space, but then this is a limited pool of capital versus like all the negative impact investors. These are the trillions that we need to unlock, and I think for us, we really want to show that it's an opportunity: climate mitigation, climate adaptation, nature, positive investments, oceans. There's lots of opportunities to really have business models that generate financial revenues, but that also have positive impact, environmental and social impact. We need to showcase. And I think also in terms of what was discussed, the investment processes to integrate better impact and ESG. I think so. We are a signatory of the operating principles and gold standard impact fund requirements. We're also an Article 9 fund, so we're trying to be very ambitious and going the more difficult path. But it also helps us to understand. So I mean, for instance, gold standards impact fund requirements and operating principles. There's lots of overlap. There's also lots of overlap with other standards frameworks. So for us, I think we can also help others, our peers, trying to harmonize, trying to better understand what works, what doesn't work, where we need to focus on. I think that's good in general, share these practices, these webinars and so on to increase the market knowledge. And I also wanted to say there are some exciting new impact methodologies and monitoring tools. We are looking into environmental DNA, which is really now developing, which will also hopefully in the future help to measure impact or biodiversity benefits in that case more easily and more efficiently.
Yes, very important biodiversity elements, complex, but it will be doable. I am going to stop there and ask Camille, can you present the results of the poll? And everybody in the audience listening to this, it's been a very rich discussion. It would be great if you could put your questions. I saw a couple of hands go up and go down. If you could put your questions in the Q&A while Camille puts up the results of whom you all are. So we have a little bit of a flavour of who you all are. Camille, is that something that the panelists will see, or is that something that we don't see? I don't know if I'll see it or not. Da-da. And she waited. And if not, I'm looking in the Q&A. Can you put up the poll, or
The poll is in the chat.
it's in the chat? It's in the chat. Ah, okay. I have to move to chat from Q&A. Okay, great. So what we see is we've got 30% project developers, no VVBs, no development finance institutions, 15% consultants, 7% consider academic, 15% NGOs, and 10% mystery other. Great. Okay, well, it's just good to know. So glad you're all there. Has anybody got any questions for the panelists? Please use the Q&A. I can see. Okay, so we have, how do you respond to manage expectations of investors who want to see returns beyond positive impact? Rita, I'm not sure. I mean, Natalie did just try to discuss that, but I don't know if anybody wants to add to what Natalie just said about the importance of ensuring that we get positive returns. I think both Marco and Natalie are practitioners, and that is exactly what they're trying to do, positive returns and financial returns. But do you want to add anything?
I mean, that is the requirement for impact investing. It's not philanthropic. It's a double bottom line, at least triple bottom line, as Natalie calls it. But you must have, you're targeting a positive environmental or social impact alongside financial returns. Now, this is market returns. They can be greater than market returns. They can be less. It's also security selection and impact matters as well. It isn't just, but you are targeting a bottom line. You cannot just target impact and be an impact investor.
Right. And then Annalena,
maybe one thing to
Oh yeah,
one thing
sorry,
to
Marco,
add, I think what is interesting is that we are really trying to indeed get positive returns, and that's in the contract with the investors. But we hedge that, basically the risk with the philanthropic capital, that is used as first loss. But I think if you look at the end result of the entire operation, entire fund, for example, that we developed with Connexus, and I will probably see the same with the Global Forest Bond, is that we will have returns for all investors, including for the philanthropic in the end, because we are trying to build something that is actually has both and the financial impact and the positive impact on the communities on the ground and on deforestation issues. It's all at the same time.
We have a very interesting question from Annalena Fuchs from GIZ, which asks, which SDGs receive the most or the least amount of investment? And are there singular SDGs that promise a bigger impact, so a bang for the buck, than others?
I'll try to address that. In looking at the signatories who target SDGs, the SDGs, when they do their disclosure statements, I mean, clean air, clean water, better jobs, and healthcare are probably the most predominant themes. You don't find somebody targeting human rights necessarily, but a lot of that is a spillover. If you're targeting healthcare, that is better equity for people who don't receive healthcare. So there's a lot. It's really hard to just target one SDG because it does have spillover effects into the other SDGs. But I think clean air, clean water, jobs, and healthcare are the ones that are probably the most common. Financial inclusion as well. Those 5.
Natalie, do you
Yeah, I
agree?
just want to address these because Pegasus, we're also the investment fund manager of the Global Fund for Coral Reefs, which is focused on SDG 14, so life below water, so oceans. So knowing that this is one of the least funded SDGs, there's not enough funding going into oceans and coastal communities, and that's why we also, with our Global Fund for Coral Reefs, we target these sectors, which is sustainable fishing. I mean, there's so much unsustainable fishing going on, extracting resources in an unsustainable manner, but also how to help increase resilience, especially for coastal communities that are primarily located in the global south. So there's, I think, in terms of economic benefits, social benefits, resilience benefits, but also biodiversity benefits, there's a lot of opportunity there, commercial opportunity as well.
Justin, did you want to speak?
Yeah, no, I think I'd just sort of reiterate from the sort of impact AUM. If you look at sort of GIN data, I think financial inclusion remains the largest sector globally, because it's been around for the longest. So therefore, SDG 8 and also SDG 1. But I think in terms of kind of bang for the buck, I think it does get interesting when, to Natalie's point, looking at underserved SDGs. We're increasingly doing work on SDG 16, which sounds very esoteric, but actually looking at the contribution of impact investment to peace and stability, and all the secondary impacts that come from that is huge. So there's a number of funds right now coming to market that have a very strong peace focus, or a focus on targeting beneficiary individuals that have been displaced as a result of conflict, or climate migration through to as a result of climate change. So I think, yeah, SDG 16 is an interesting one at the moment.
Thanks. Nicholas,
I just briefly wanted
before you
to
do,
add.
Sorry, Nathan, just before I'll come to you, but I just want to flag to Nicholas, who's got his hand up. I can't give you the floor, so if you could write your question in the chat or the Q&A, then we can respond to you. But Natalie, over to you.
Yeah, just wanted to add in terms of how to achieve the bang for the buck impact for all the SDGs. I mean, we talked about blending. I think there's also, and we do it as well, blending of grants in form of technical assistance to support portfolio companies or even the local communities next to or where the portfolio companies are operating, to achieve greater environmental social impact through technical assistance in form of capacity building efforts, to help them measure the impact, to help them engage with local communities in the agriculture space, help smallholder farmers to transition to regenerative agriculture practices, because it's also, we need resources for that. It's not, if we tell the smallholder farmers you just have to do it, I mean, there's a lack of capacity building capability, but also it needs resources. So I think just across all the SDGs and impact investing, I think technical assistance, the grants is also a critical component.
Great. I'm looking now for Nicholas's question, but I can't see. Is it in the Q&A or hold on here? Chris Evans, a recent analysis suggested the concessionary capital available for nature and climate has remained static over the last five years, and public development funds are only allocating 1 to 3% of funds into blended finance transactions. What is the view on how flows of concessional capital can be mobilized towards nature and climate goals? Who would like to take that? How do we get more money to nature and climate, given that currently it's not in?
Well, I think that's exactly what we are trying to do in Brazil. So we have to be creative in developing the types of funds and the way we structure them. And I think, as I mentioned already, there's a significant amount of patient capital and philanthropic capital there that will help unlock those concessional funds. For example, with Global Forest Bond, we're aiming at a €100 million fund, so it's a significant amount of money, and that's going to be basically all just pure market capital. And with Connexus, we're developing a fund which is going to be probably about 5% philanthropic and 5% to 10% patient, and that will unlock another 85% concessional fund. So I think that's more sort of what we're looking at.
Great. I've got some more questions. So I've got a question here. It says, I'm going to hope that Amit, this also responds to your question. This is a question from Annalena. In order for a company to engage with an impact investor, how advanced do they need to be? What data do they need to provide in order to support the sustainable development claim, i.e. what the investor is trying to say? So in Amit's question is similar, which is, how do you interpret impact investment? Like what is the claim, and then what is the claim that impact investors need to make? And then if they're making that claim, what data do they need from the company that they're investing in?
I mean, I can address the first question from our practitioner perspective. Is it enough to just say we contribute to SDG XYZ. I think we need to unpack it. At least for us, it's not enough. So we need to understand what is this claim, where is it coming from, and ideally also in quantitative terms, in addition to a rational. But that being said, we are very happy to provide guidance also with our technical assistance. We actually have the ability with grants also to investigate more what can be the impact of the investments. For us to ensure during screening or due diligence, when we assess the investment, that we can actually make the claim. So I think it's also shifting towards for impact investors what they demand when a company approaches an impact investor.
Anyone want to add? Otherwise, I'll go to there's lots of great questions. So thanks to everybody who's writing questions. If someone's got their hand up, please put it down. I can't give you the floor. There's too many people on this call. So if you could just write your question and we'll try and get to it. So this is a question which is about positive and negative impacts. Another term for negative impacts is doing harm, and most people actually have safeguards to address that, but we can come to that. So how do you manage the fact that most actions or activities will always have some negative impacts as well as positive? It's rarely just a positive story. So how do we manage that as an impact group? And there's also talking about concessional finance. I'll leave the concessional finance, Nishant, because we had a long discussion about that earlier. But I would like the panel to answer, how do you deal with negative impacts? How do we make sure the overall sum is positive? What are you doing? Who wants to answer that? Diane?
Sorry, I can start. This is part of, ESG alignment is monitoring for the potential negative effects of an investment, and that's why Principle 5 for the impact principles is the foundation. You must be able to monitor for the potential negative effects before you can talk about having a positive impact. So really, I guess the answer to that question would be ensure that the investors are signatories to the impact principles or have signed up for the gold standard, done both, they're held accountable, and they have to quantify and also provide qualitative measurement for how they're doing that monitoring. They can't just say are having a positive impact if they're not also telling you how they account for the potential negative effects. So that's where regulations can also help, but there are just standards already outstanding that you want to make sure that investors are signed up to.
Yeah, and I think that also flows down to investments into portfolio companies that, part of, again, that sort of due diligence process is typically there's an ESG due diligence process, but also then an impact due diligence process. And the ESG due diligence process would really look at, whether a potential investee does have robust environmental and social management systems in place. It has the ability to identify where it is currently having a negative impact and has mitigation plans in place. And there's a clear pathway to addressing those. And I think that forms part of the overall decision-making process. Go, no go decision on investing into that deal or not.
Yeah, I echo that. And also, gold standards, environmental, social safeguards, IFC performance standards. The EU regulation is very much focused on these topics as well. The do no harm principles, principle adverse impact, that cover these topics as well as SASB, GRI. These are standards, frameworks that can be consulted to identify the issues.
Okay, I want to end on a positive note, so I'm going to take from Diane. So I'm sorry, public, we're going to, all of you, and thank you so much for all your questions. It's been great to have that input. I would like to enter on the panel on a very short, we've got 3 minutes, so you've got like one sentence only. What is the one thing that you think in your position, in your organization, you can do to make a positive change? Like one thing. Like of the many things you're doing, like what's your number one thing that you can think of now on the spot that we can end on a positive note? Diane, then Natalie, then Justin, then Marcus.
Okay, very quickly, the impact principles were created to, build standards for the market, and the collaboration opportunities that signatories have with each other to develop best practices for the market it's started early with harmonization of impact indicators. We've gone into impact reporting or working about reporting under the regulatory environment. So this collaboration of actual operating companies is critical in developing, robust best practices for the market.
Yeah, I think for us it's adopting those best practices that are in the market. So keep trying, learning, sharing what we learn with others as well, and also still convincing other investors to really come into this market, which is there's lots of opportunity to create impact, but also returns.
From our side, I think it's helping a couple of large private equity and private debt conventional managers move into the impact space credibly and at scale, and we're really working hard on doing that right now. And then on the completely other end of the spectrum is working with managers to do really high quality, granular, disaggregated outcome measurement, because the market's hungry for this right now, and that evidence of whether impact's actually happening in the field.
Marco?
Yeah, I think what we started with about bringing together the group of practitioners on the ground to do projects and the financial industry, supported by the impact investors, to get that dialogue going and really create new innovative mechanisms that can actually deliver large results. And as Justin said, bringing the big players into this area. Thank
you. Now, before we go, I'd like to thank all of you, Diane, Natalie, Justin, and Marco, for your preparation and inputs, and thank you all on the webinar. And last but not least, I'd really like to thank Jamie and Camille from the Gold Standard Comms team for your support in setting this up. And with that, it's 5 o'clock and we are on time. Thank you all very much.
Thank you.
Thank you.
Thanks, everyone.
Bye-bye.
Thank you.
Thank you.
Bye-bye.
Bye-bye.